Brian Stevens here with the National Real Estate Post. We have a really important show for you today that I think is going to be illuminating for you. We have Chris Whalen, and he's an investment banker, and he's a writer who lives in New York. He's the chairman of the Whalen Global Advisors, LLC, and focuses on the banking, mortgage finance, and fintech sectors. Chris is also an author of several books. He's a contributing editor over at the National Mortgage News and appears in a variety of other publications and media. He's a member of the FINRA and is a senior advisor at JVB Financial Group in New York. Now, Chris brought something to light that came to me third hand, and I'm going to tell you right now, as I just told Chris, I'm a little bit on the weeds here. But how Chris posed it was with these new issuer eligibility standards that Ginnie Mae is putting out right now that you refer to as bizarre, and you say that this can crush many government lenders. Can you explain that a little bit more for us?
Yeah, no, I'd be happy to. Thank you for inviting me. What's happening is Ginnie Mae is trying to mimic the bank regulators and impose bank-like capital rules and liquidity rules on mortgage banks. So, for example, the calculations they have in their proposal would force mortgage banks to cut the leverage, the borrowing, that they use to support mortgage servicing assets, MSRs, in half. So instead of having 50 or 60% leverage that I can get from a bank today, I'd have 30%. What that means is that the returns on those assets would be cut. And frankly, from an economic perspective, it wouldn't make sense for me as a mortgage bank to retain my servicing anymore. It would cut the value of the servicing dramatically. In fact, I said in the piece I published in my blog, it would probably cause the market to crater. Today, conventional servicing is trading for 5-6 times cash flow. It would probably fall to 2. Okay, so all of you viewers out there who are in the business, their primary capital asset other than term debt and borrowings from the bank from a warehouse line would be decimated. And I think you could see tens of billions of dollars in losses for both banks and non-banks, because there's still banks out there that own Ginnie Mae servicing. So this whole part of the proposal where we subtract the value of the excess, in other words, the value of the servicing, besides what you got to get paid just to service a loan, which is usually 4 or 5 basis points maybe, is crazy. That's far more draconian than the bank regulator. Bank regulators don't do that. They penalize you for a big MSR, but they don't make you subtract it from your net worth. So where on earth this proposal came from, I don't know. But the bottom line here, what people need to take away on this proposal from Ginnie is, I don't think it was fully baked. I don't think they really considered the consequences of their actions. And I think from an economic perspective, just in simple terms, it doesn't work. So I think Secretary Fudge, the folks at Ginnie Mae are going to have to go back to the drawing board. And I feel bad because this is a great agency. They've been very helpful to the industry over the years through COVID and everything else. And to have this kind of a stumble, this kind of lack of focus, lack of diligence on a very important proposal, I think is really a terrible tragedy.
It's kind of, the road to hell is paved in good intentions. What do you think the motivation ultimately was behind this? Even though we don't like what the unintended consequences of it are going to be, why do you think this would have been proposed in the first place, and why now?
Well, Ginnie Mae, I think, was waiting for the Federal Housing Finance Agency to finish their rule. And they are kind of in the middle of the process. Nobody knows what they're going to do next, but they're late. Director Calabria indicated they were going to come out with another request for public comment, and that hasn't happened. The Ginnie folks want to get their rule in place so it's effective next year with financials at the end of 2022, and I get it. That's fine. But you got to come out with a rule that makes sense. If you're going to decimate all of the small and mid-sized mortgage banks out there that currently retain servicing today and turn them into brokers for Jamie Dimon at JP Morgan and cause lots of losses in the industry, by the way, the industry would probably lose 1/3 of its capital as a result of this rule, just because the servicing would be unsaleable. Nobody would want it. And keep in mind, as you and I are sitting here having this conversation, banks, rating agencies are all reacting to this Ginnie Mae proposal. So the folks at Ginnie Mae, Greg Keith, particularly in the risk section of that agency, have set in motion stuff that they don't understand. And I think you could see issuers in serious trouble simply by having this proposal out there. Whether it actually gets approved and finalized is another matter, right? But just by questioning the net worth of all of these significant issuers in the Ginnie Mae market is not helpful. It really is not.
So you had mentioned that it was up for comment period and then it's not up for comment period. Is this something that they're just rushing forward with and they're not going to put this for comment period? What's the disposition of it right now?
It's unclear. Ginnie Mae took the position in this 6-page document that it's not really a request for comment. In other words, they thought that they could just issue this without asking any input from the industry. I think they're mistaken. I think that this is so serious and such a radical change from current practice that they need to ask for public comment, and they probably need to extend the comment period beyond the first week in August, because that's not going to happen. You know, the fact that they thought they could come out and ask for comments in 30 days in the middle of the summer as people are coming off the COVID lockdown, I thought was rather thoughtless. And, you know, bottom line is they got to go back to the drawing board. I think HUD Secretary Marcia Fudge has to withdraw this proposal, and they should apologize to the industry and they should go back and get it right. Because I'll tell you what happened here. There's a vendor, a very large global accounting firm that does all the analytics for Ginnie Mae. And they took the position that, well, one size fits all will work just fine, and this will not be a big deal. So the Ginnie Mae folks took that message from their vendor and ran with it. But they didn't bother to go talk to any issuers. So the issuers I've spoken to over the past week are very angry. They are not happy, and they feel slighted, and I think a little disappointed in our friends at Ginnie Mae.
When you say that this could decimate a lot of our non-banks out there, is that another way of saying it could put them out of business?
Oh yeah, it's going to radically change their business. Look, if I have a servicing asset, let's say it cost me 50, 60 basis points to create when I made the loan, right? And I sell a loan, but I keep the servicing asset. I haven't capitalized it, it's still on my books, but I do assign that value to it, say 60 basis points. If suddenly the market craters and there's no bid for that asset, guess what? I got to write it down. My net worth is going to fall. So, you know, the whole logic, yeah. And all these little mom and pops that serve the manufacturing housing world or smaller lenders, so they're not necessarily popular with the big servicers and the big banks. Well, guess what's going to happen to them? All of those shops are going to get annihilated because they don't have a lot of capital. You know, most mortgage banks do not have any net working capital. They borrow money from a bank. That's how they operate. And yet all these regulators want to treat these like banks, like there's some kind of source of strength and they have government insured deposits and everything else. No, these are finance companies. And to treat them like banks, I think, is really wrong. It reflects an ignorance of finance that is breathtaking.
Okay, so I think I understand this now. So they have to have their net worth. If they can't sell off their servicing where they're actually making money on it, they're going to have to hold that, and they're going to have to write that down against their net worth, and it will essentially put them out of business.
That's right. And let's say they survive. They'll still stop retaining servicing. They'll give it away. They'll sell the loans with the servicing to somebody like JP Morgan or Wells Fargo, who will get the benefit of the cash flow, but won't have to pay the penalties. You know, remember, these rules are harsher than the rules that apply to commercial banks. That's the most bizarre aspect of this. The folks at Ginnie Mae and HUD for years have talked about protecting the government asset, protecting the market, protecting investors in Ginnie Mae securities. We've heard this over and over again, and then they come out with this rule that goes 180 degrees in the opposite direction. It's just inexplicable. It really is. I don't know what to tell you. I read this document a couple of times and I couldn't believe it. And then I started talking to issuers, and it became very clear to me that, you know, Ginnie's got a problem here.
Well, and you had mentioned you thought the timing of when this was released late a couple of Fridays ago, it sounded to me like you felt that was intentional, like a very convenient way to bury something that was going to be unpopular.
Yeah, but I don't think the Ginnie Mae folks honestly thought this was going to be a big deal. I think the consultant told them this is not a big deal, and they ran with that. They didn't do the analytics themselves. And I think that all I can say is when you look at how the bank regulators have developed the risk weightings for Basel, that took decades. It's an iterative process that goes on indefinitely. And it took a lot of work and a lot of money. It's extremely expensive. So obviously Ginnie Mae doesn't have the resources for that. Mortgage bankers certainly don't have the resources for that. And to come up with something like this that is really half-baked and it has some fundamental flaws in it, like subtracting the value of your excess servicing from your net worth. That makes no sense at all. And the fact that Ginnie put this out here for public comment, I think is so unfortunate. It really is.
So what is it? There's really nothing that anybody on a, who's writing loans on the streets can do about this. Any, writing letters?
No, I would get in touch with your congressman and say, hey, what's going on here? Because I'll tell you what's going to happen. This is going to ripple through the market. You could see banks reducing funding for small mortgage firms. You could see rating agencies downgrading large mortgage firms. This could affect stock prices. So this is going to ripple through the industry because, credit people react to stuff like this. And when a major federal regulator like Ginnie Mae comes out with a proposal like this, that is such a change from current practice, people pay attention. Money moves. And I'm worried about this. I think that the folks at Ginnie have set in motion some processes in the credit markets that we did not need to see right now. Totally unnecessary.
When will we know any timetable if this is actually going to be implemented or not?
Well, they've asked for comments through the first week in August, and then we'll see. But I hope and expect that Secretary Fudge is going to be addressing this issue publicly soon. I can tell you the mortgage bankers and the other trade associations are definitely speaking to them right now. This is something that surprised people. They were not expecting this. So it brings back memories of the bad old days under Director Calabria at the FHFA, and we did not need this right now. It would have been nice to have a nice summer, We'll do risk weighting in September after Labor Day. How about that?
Well, hey, listen, guys, there's definitely going to be more on this as we're going forward.
Oh, yeah.
How can my viewers get in touch with you? Or not, excuse me, how can my viewers follow you? I'm following you on Twitter right now, and I've got your blog, but can you let my viewers know where to follow you at?
Sure. Of course, I write a column for National Mortgage News, and I publish the Institutional Risk Analyst, which is my old blog. It's been around for quite a number of years now. And that's the easy way. Or follow us on Twitter. We're always having fun. We got this hardcore group of credit guys and journalists and gals, so it's a lot of fun.
Well, I love it. And hey, listen, thank you so much for bringing this to everybody's attention. This one came out of left field for me today, and so again, I was on the weeds on this. A lot of this is above my pay grade, and thank you for making this more understandable for me and folks like myself who need to know this type of stuff. Thank you so much, Chris.
Get on the phone and call their congressman right now.
Oh, we're gonna. Trust me, we will mobilize.
Mobilize.
All right. Thank you so much,
Thank
Chris.
you.
All right, bye.